Hi everyone, welcome to mykayaplus YouTube channel. My name is JP. So you are going to watch a previously private video made for our Premium Club members. So as mykayaplus slowly renew and update our Premium Club services, we have decided to make this private video into a free content for your viewing and learning pleasure. So we hope that you enjoy this lesson and this video. Okay, welcome back. Good evening, guys. This is our September private session. So for those who are joining us live, thank you for your time. And for those who are not joining us live, rest assured that being a Premium Club member, you are eligible to stream it and watch it back at your own pleasure. And if you have any burning questions, you can also shout out the questions at our Premium Club Facebook group, and we will try our very best to answer and cater to your queries. Of course, today's topic I think is a bit important, right? We talk about stocks, we talk about even the mentality and approach on investing, but one key aspect of managing investment is actually how portfolio management. So how to do it right? Maybe Chun-Ming, in your own words or opinion, what do you think of portfolio management?
I think at the end of the day is you need to matches on what you really want to achieve, and of course based on what you achieve, what you want to achieve, you need to make some plan. So it's like you wanted to play a game. The end goal of the game, let's say Minecraft, is to set up a very nice castle in the space. Let's say you like the space style. So based on that, you need to make sure the whole concept of the things, you need certain materials. So you go after the materials. So to make the whole material works, basically you need to have a few combination. So it won't be a single thing lah. At the end of the day, when you set up a castle, you need to have the gate, you need to have the whole outlook, you need to have some sort of defensive kind of thing. So all these things built up is basically how you actually build a portfolio. Overall, it need to be able to attack and also can defend. I never see any teams in football. It's like putting 10 striker and then one goalkeeper, and they're able to win the match. So this is the reason why we need to manage it well. But be it 4-4-2 or 3-5-2 on a more attacking ground, it's up to your appetites. But at the end, you need to decide formation, and it cannot be everything about attack or everything about defense. You need to strike a balance. Else, when something bad happen, it can hit you super badly.
Yeah, I think you put it very appropriately, and using a lot of analogies from castle having the defensive mechanism, and also to also attack, and also from football formation as well. I think you pretty much cover all the important aspects, which also why I chose this picture as the title or the cover page for today's topic, which is portfolio management. Basically, you can see it as nasi lemak, right? We Malaysians, we are very familiar with this dish. It is the national dish. So when it comes to nasi lemak, you always have rice, you always have proteins, chicken, fish, prawns, and you also have your peanuts, anchovies, and sambal belacan, and also cucumber. So everything is there. Every part, every ingredient plays an important part. So you cannot don't have a certain material or certain ingredient and then you call it a nasi lemak. It doesn't make sense. But if you have all of these ingredients together, you can have more chicken, you can have more vegetables, you can have lesser rice. It's still nasi lemak. It's how at the end of the day we get the ingredients right, and then we play around with each of the ingredients ratio to our personal preference, right? So this is how I actually thought about it, and I used the nasi lemak picture as a kind of methodology or kind of image to actually portray to this topic on portfolio management. Of course, we will go straight into the topic. Disclaimer, we will be talking about real stocks, but do not take it as a buy, sell, or hold decision, and do your due diligence before you actually invest into a stock that you are interested in. Right. I think right here you can see straightforward when we talk about what portfolio management is basically balancing or creating a mix of investment products, right? And these investment products can be stocks, it can be REITs, it can be ETFs, it can be bonds. It also can be mutual funds, and for those who have a little bit of higher risk appetite, they can also go into commodities trading, right? Going into futures contract and then make a few quick buck in betting on the commodities direction in terms of the price changes, because it's more volatile. You think stocks is volatile, wait till you go to commodities, you can see that one news can actually make the price swing double digit, either upside or downside. So, and I don't think there is a tight or stringent limit up, limit down mechanism for commodities. So this is how fund managers or even the so-called professional investors or seminar or even the remisier will tell you about what portfolio management is, right? But to actually make things simpler and more easy to digest, as I said, I will probably want to take a more easier to understand analogy, which is you just think of portfolio management like, a plate or a serving of nasi lemak. You have your rice, you have your protein, you have your chili, right? Your sambal. And to actually put an investment product or type of investments to signify of it, you can think of it like if rice is the main ingredient for nasi lemak, and then I would say that maybe your liquid savings or your capital would play the most important part, right? At any one time, you do not want to don't have any rice and call it a nasi lemak, right? It is the most important part of a nasi lemak, and hence also one of the most important positions when it comes to having inside our portfolio, because at the end of the day, we don't know whether the market will go up or go down. But if the market goes down and we still see a possibility to buy stocks at a cheap price, this is where we actually employ or deploy our so-called capital and our savings when we buy stocks at a cheaper price. We never know whether they go up or go down, right? And then of course, other than that, other ingredients can be, representing different kinds of sectors, right? You can have your healthcare stocks, your growth stocks, or your private healthcare stocks, right? Top Glove, Hartalega, or even companies like KPJ, right? If you really studied or come across a good healthcare stock and you want it to be a component inside your portfolio, you can actually have a segment coming from contributing from your healthcare stocks. Then you also have your banking stocks, or you also have your REITs, and then you also have consumer discretionary, so your FMCG stocks like Nestle. What else? QR Resources. So these are the companies that are relatively defensive. Even if there is an economic downturn, you do not expect huge challenges to be faced by company, because they are actually selling or in a business where they are in a resilient kind of business. Even though economic downturn, people will still need to buy food, right? And last but not least, the spicy part or the spicy element of a portfolio is usually the more exciting one. Some people really love to have a lot of sambal inside their nasi lemak. So I would actually categorize the sambal as an ultra growth stock. Some people love to have a lot of chili inside their nasi lemak. Some people can't take it, so it comes with just normal curry gravy. So this is how I want to approach it, and actually it's not that difficult to actually explain or to teach people how to manage their portfolio wisely. Right, and of course, if you really do eat a lot of nasi lemak, you can really know that there are many different kinds of nasi lemak, right? From different kind of states, they have different kinds of variation. Even some don't actually come with chicken, some come with prawns, and some come with daging rendang, right? Or your beef. So and you cannot say that one of it is actually the best, because maybe to you, you really like nasi lemak with chicken, but for other people, they prefer it with seafood, and for another person, they really prefer it with daging rendang. And hence, the key misconception that most people are having is that there is an actual ideal portfolio, and you die have to follow that kind of portfolio. So I'm here to dispel the myth is that everyone have their favorite plate or ideal plate of what is the best nasi lemak. The same goes to their portfolio. You cannot actually jump out and say that you're buying too little income stocks, or you are not buying any growth stocks, and you are doing investing wrong. I think the investing is, at the end of the day, well suited and tailored personally by each and every one of us. If you really like to invest in high growth stocks, by all means, you can totally ignore or have a very little allocation of income stocks in your portfolio. Put more into high growth stocks. But if you're someone who are really scared of the volatility, then you can really fully focus into income stocks. There's no right or wrong. Yeah, 20 years, 30 years down the road, the results might be different. The end goals might also be different. But that doesn't mean that you have failed if you actually took one path and you didn't took the other path. Right? So yeah, basically, some people really love ultra high growth stocks. These are the so-called people who enjoy the excitement, seeing the price go down, then they buy more, and then when the share price goes up, then they feel very excited. But there are some people out there who, once they see the share price even go down by 10% or 20%, which we will also touch a little bit more later, real life case scenario, when the so-called China tech stocks actually went down by so much, a lot of people are actually having double thoughts whether you need to cut loss or you still hold on to your companies or not. So if you cannot take the volatility, then this is the key indication that maybe you have bought too much of it, or your heart cannot really take it, or you may not really understand the company so much, or the so-called governmental policy so much that you are actually anxious when you see stocks coming down due to a big correction, right? And of course, some people also have their own personal preference. Maybe every time they go out for nasi lemak, they always order nasi lemak with chicken, right? They don't take it with beef, they don't take it with fish, and that is okay, right? For me, I pretty much enjoy good nasi lemak, whether it's with any types of protein. If it's good, then it's good. But some people, they have their very strict preferences, and they only stick to a certain kind of protein when they go with their nasi lemak. And of course, at the end of the day, you cannot say it's wrong, because at the end of the day, it's a personal preference tailored to each and every person's taste bud, right? And of course, last but not least, some people really, enjoy making and picking stocks to make their own portfolio, right? So if they really like this stock, and then they've analyzed it, they've studied it, and then they say, okay, price is good, then they will put it or buy it into their portfolio. So in some ways, this is pretty much like cooking up or building up your portfolio from scratch. And the other end of it, the other spectrum of it, you have people who are lazy to cook but still enjoy good plate of nasi lemak. Then what they'll do, they'll actually opt for delivery, and then they'll just buy the nasi lemak as it is. So this could be the warung that you always go to and you really like, and then because you're so lazy and used to eating out that kind of a complete set of meal, then you just opt to buy the whole nasi lemak packet as it is, without going through the hassle of cooking and building everything from scratch. And there's no right and wrong again, right? You cannot just go and penalize someone else because they choose to invest in ETFs. They want a quick solution, a basket of stocks tailored to suit their risk profile. And then, of course, at the end of the day, when you tweak your own portfolio, you build your portfolio from scratch, you better know the risk yourself. And then you can even make it so personalized that you are very happy with it. Whereas for a ready-made portfolio like an ETF, sometimes you just got to accept the downside of the portfolio. Say, for example, stash away, right? So some of you might have invested in stash away, and then you notice your stash away came down a lot because one of the components inside stash away is that they do invest into China tech stock. ETFs. And as we all know, China tech stock got sold down pretty badly, and hence it will actually impact your stash away performance. And can you really blame stash away? You can't, because nobody expected that. And prior to that, actually, this China tech ETF was actually one of the key components that actually helped stash away achieve their so-called very consistent and yet reliable kind of return. So you cannot really blame a package or a black basket of portfolio or ETFs because you already chose to actually buy the entire thing as a basket. Right. So of course, there are a few guidelines when it comes to doing portfolio segmentation or portfolio management. The way I see it, also to tie back to the so-called how you actually see a play of nasi lemak, is that you always have your key sectors that you're more comfortable with, the one that you're 50-50, comfortable, confident, you still know a little bit of knowledge, you still analyze the companies a bit. And there's also the ones that are relatively maybe higher risk to you, might not be higher risk to anybody else, and you choose to allocate a smaller segment of your portfolio. It also could be you are more of a growth investor, but you still have a small component of a portfolio coming from relatively stable industries or business like banking, right? So this is one example that you can actually categorize your stocks inside a portfolio. So go through your portfolio. If you have 10 stocks inside there, look through all of them and then categorize. And then you will see that maybe out of these 10 stocks, 5 of it is actually from the banking segment. And ask yourself, are you happy with having 5 banking stocks inside a portfolio? And what are the risks that can actually happen or can affect your portfolio by having 5 banking stocks? So if you rewind back the time to last year, if a pandemic were to come again, and then if there's a market sell-off, then of course your portfolio will be badly affected because half your stocks inside a portfolio is derived from banking. And as we all know, banking stocks or the so-called financial institutions usually will get hit hard whenever there is a economic downturn or a pandemic. So you always need to come up with that kind of segmentation so you know what are the risks are and when your portfolio will be impacted. So another way to also segmentize is also by looking at your REITs, right? We know REITs is a good dividend pay master kind of investment vehicle, but if you look deeper down, REITs can actually be broken down into or grouped into a few categories. Your retail REITs, like your shopping malls, that should be the commercial REITs. So commercial REITs is your office buildings, and then your industrial REITs, your REITs that own industrial properties, functionalized as factories and also warehouses, and then last but not least, your warehouse or your healthcare REITs, which is your hospital REITs as well. So by also looking deep into your REIT segmentation, you also can know that under what circumstances will your portfolio be impacted based on what kind of REITs you have actually invested in. So you can be more prepared for the downside, but also position yourself to enjoy the upside if there is any positive catalyst in terms of whatever kind of recovery there is lah. And of course, you can also segmentize or manage your portfolio in terms of the geographical breakdown, right? So in terms of, say, for example, you have a portfolio of stocks, 40% comes from the US, you have 40% of your stocks in US companies, and then another 30% of it coming from your China or Hong Kong, and then maybe another 20% coming from Singapore, and then last but not least, 10% coming from Malaysia stocks. So you can also categorize your holdings into geographical segmentation. Then only you can also take a deeper thought about it every time you monitor your portfolio. Are you buying too much Chinese stocks, or is the Singapore stock portfolio component in your portfolio requires adding, right? So you always have an end goal in mind, and then you ensure that your portfolio is constructed to meet that end goal in mind. Right. Of course, if you zoom down into ultra growth, right, high growth kind of segment, or what we at KayaPlus call it the thematic kind of investment potentials. We have covered EV, we have covered semiconductor, and coming up would be e-commerce, and last but not least is cloud. So you can also segmentize your ultra growth segmentation into a portfolio, and then try to gauge from there, are you actually happy or confident with the kind of breakdown? Say for example, if you are more certain that e-commerce is actually going to grow steadily compared to electric vehicles, by doing this kind of segmentation and portfolio management, you can actually gauge that whether are you overbuying on EV stocks or not putting enough capital in e-commerce. At the end of the day, it's really to spell out clearly, are you actually following what you plan at the initial phase, right? If you are confident on e-commerce, you have the data and the numbers and the justifications that e-commerce can actually grow faster than EV, then logically, you should have more capital into e-commerce stocks because you want to ride on the higher potential upside. But if you look into a portfolio and realize that EV stocks are actually having more contribution compared to e-commerce, then this is a time you have to reflect. Do you actually put in more money or more of your future capital to e-commerce so that the e-commerce percentage becomes higher than EV, or you want to chop off some of the less promising EV stocks and then transfer it to an e-commerce stock that you're more comfortable with? So this is how portfolio management works, is actually to paint out the entire picture of your stock portfolios from the numbers and from the company names into a simple visualization pie chart. And then from there, you gauge yourself, are you happy with your portfolio in terms of the segmentation? If you're not, you have to do something. If you notice a mistake, then you have to rectify it before it actually becomes something that, that will actually stray away from your game plan, right? If you are confident in a certain segment, that segment should have a higher allocation because you do not want to take risks of investment potentials that you are not aware of. And I think another aspect to look at it is also from the value stream segment. So a lot of business actually covers a very huge value stream, right? Say for example, your semiconductor, we talk about it, you have your upstream, you have your midstream, you also have your downstream players, and you will always know, once you understand the entire value stream of or the value chain of a semiconductor, you know that which of the streams are making the more profit and has the highest potential and has the highest net profit. And from there, you can also strategize your portfolio so that you are capturing, in terms of allocation, the ones that are more profitable, the ones that are more potential, than the ones that are not so potential. Maybe you omit them or you have a small allocation inside a portfolio. Then at the end of the day, if your thesis and your so-called analysis are proven right, then the stronger companies with the higher allocation can actually pull your entire portfolio up. Right. Last but not least, I think would be the shareholder value segmentation. This is at the end of the day how you gauge in terms of returns. What are you happy with? Are you going to be happy with income gains? Are you going to be happy with more capital gains, or you want to have some stocks which actually provide a mixture of both? So you have a mixture of both in terms of income gains and also capital gains. So that is also a way to gauge your portfolio and manage it accordingly. You want to have a certain percentage coming from growth stocks that gives you capital gains, and a certain percentage that gives you income gains as well. So at the end of the day, there is no right and wrong on how much allocation is the ideal scenario for each and every one of us. Everyone has their different preferences. So the only way to know whether this kind of breakdown is suitable for you is to ask questions, right? So say, for example, this is an model portfolio of someone else. And you can see in terms of the percentage-wise, the US is the largest, maybe at 30% or 40%. Then the China stocks at 30%, and then Singapore at 20%, and then Malaysia at 10%. So in terms of the pie chart percentage, China is actually quite big with 30%. So of course, with the recent sell down, every one of us who have China stocks inside our portfolio, we will be asking, what if governmental policies continue to pressure China stocks? Are you happy or are you comfortable having 30% of China stocks in our portfolio? So this is one question you can ask yourself. And of course, zooming into Malaysia, if Malaysia COVID cases were to continue at the higher levels, are you still confident of having even 10% of your stocks in Malaysia? So these are the questions that we have to ask ourselves, and each of us might have a different answer. So if someone is actually confident and okay with the volatility and the uncertainty of the China stock sell down, then they can actually look at it as an opportunity, and they can actually increase the 30% to as high as 40% and 50% because they are actually confident of a rebound. And this is a one-off kind of governmental policies initiated kind of correction. And then for those who are more confident that the COVID cases will actually be stable and then come down for Malaysia, so they also can actually take it as an opportunity to buy up stocks that are at a cheaper price as well. And of course, if you're someone who thinks the other way, if you are not confident of the sell down of China stocks, then perhaps if you have capital, you need to put it into your US stocks or any other components inside your US stocks or portfolio, because at the end of the day, you don't want to take on risks that you are not comfortable with. And of course, if you don't think that Malaysia COVID cases will spell a smooth recovery, then perhaps you should actually put more capital into the Singapore stock market, where Singapore is relatively in a much better state in terms of reopening up the economy. So it's really up to each and every one of us in terms of risk analysis and also our risk appetite as well. So to give you all an example, a real life example, so this is what really happened to me. So you can see on the left side is currently my portfolio. For US, it's currently taking up 32% of my total portfolio. China stocks, Hong Kong stocks is around 28%. You have 26%, 25% in Malaysia, and then the balance 15% in Singapore. Of course, the China tech stock got sell down, and then even though percentage-wise US is actually much bigger, but I do think that at the time of moment, I would rather have my money deployed into the US market because of the uncertainty. Right. So of course, I would actually ask myself the same questions, but I am positive that the Hong Kong and China stock markets or stocks inside this tech-heavy segment will actually recover in the mid to long term. This is my personal opinion only, but doesn't mean that my opinion will turn out to be the truth. And then of course, what if the correction is just starting? There could be more correction coming out, right? So even though I am positive that it will recover in the mid to long term period, but I do know that in the short term period, there might be more correction. So I have to be careful without being too greedy, just because share prices have fallen by 20 and 30%. It can even go up to 40 and 50%. So I cannot be too greedy when it comes to even averaging down a certain company that I am positive with. And then, of course, one of the key companies inside my Hong Kong or China portfolio is Alibaba Holdings, right? So, of course, the share price have came down a lot, and it would be a good price to average down Alibaba at the current price. But if I were to do that, the percentage or the whole contribution of Alibaba group inside my portfolio would actually be higher. And I do not want it to be higher because I want to manage my portfolio more accordingly. So yes, the pricing might be attractive, but because of the huge weightage, I actually put averaging down Alibaba on hold, and then I would want to wait eventually if the so-called contribution of Alibaba is diluted down by me buying other stocks, then if I do have still the opportunity and the capital, then only then I would consider averaging down Alibaba. Right. And how do you want to buffer it or counter react it if China stocks will continue to go down? And putting more money into China stocks right now means losing more money in terms of the unrealized loss. So how do you buffer or counter? So the best way forward is actually to buy a US-based stock, because US-based stocks right now, at least, are not so heavily impacted by the CCP governmental policies. So this is how you counter-react by buying into a US-based stock that can actually ease out or even out the so-called unrealized losses initiated by the China tech stock sell down. So straightforward. One of the reasons also to buy another complementing competitor of Alibaba is that if Alibaba were to suffer in terms of their future performances, it will come from a few competitors, right? Alibaba will not perform if they do not perform in the future, might be due to getting their market share eaten up by the competitors. So there are other competitors in China, but for someone who are more familiar with the Southeast Asia market, which is also a good key growth area for e-commerce, we are actually quite well aware that for Shopee is actually one of the strongest competitor for Lazada, which is under Alibaba. So you have to think of building a portfolio also, so that if Alibaba fails, there's another company or another component supporting the entire portfolio. So one of the key candidates to actually help support Alibaba from misperforming in the future would be actually to consider having C Limited inside your portfolio. So, but at the end of the day, buying C requires capital, and I do not want to exhaust my existing cash capital on hand. So I have to choose to sell off one company and then use that capital for selling off this company to buy into C Limited. So looking at my current US portfolio, there are a few stocks that I really like. And then, of course, I have to choose one that I like the least in terms of growth prospect. Out of these 5 companies, I think Salesforce is the one that I think I see limited growth compared to the other 4, like Facebook, Microsoft, and Alphabet, and even Apple. So what I did was I compared the historical performances. So Salesforce is growing around 23% year on year. Good, but not really great. And if you look at C Limited, they have been growing triple digits year on year. So it's a company that is very aggressive in growth. They have been laying out their growth strategy really well. And you can see that share price has also trended along with their improved kind of performances. So what did I do? Excuse me. So I actually bought Salesforce last year at around $180 USD per price. And then I sold it off because I need capital to deploy it to C Limited. So this is where I got my realized gain of 33%. And then by deploying what I have sold and got back from Salesforce into C Limited, I basically switch my portfolio. I balance out my portfolio so that I still have a strong growth contributor inside my portfolio. It's still a US-based company, and I still maintain my liquid cash because I do not want to exhaust my liquid cash, because there could be some buying opportunities because the market is pretty much volatile these days. So this is how you justify, as an example, of why even though share prices of tech stocks, particularly from China, could be very lucrative, but from a portfolio perspective wise, you do not want to be overexposed to the uncertainty in terms of the short-term potential share correction, right? So you have to justify for someone who really haven't ventured into having any China stocks or Hong Kong stocks inside the portfolio, and you just wanted to get started. Perhaps this is a very good chance to get your first purchase, because prices have been down for 20 to 30%. Some companies have even seen their share price coming down for even 40%. So this is the kind of justifications that we have to make. It's different for everyone. For me, I chose not to average down, but for someone who haven't has any China and Hong Kong stocks, perhaps it's a good opportunity to initiate a small tranche of your capital. Right. I think the summary is that we all know what a good stock is in terms when we study the business, and then we come up with the intrinsic value of the stock, and also understanding what are the growth prospect of the stock. But at the end of the day, to really be successful in investing is not just buying onto one stock and holding it forever. You really need a collection of it, a portfolio of it, and as Chun-Ming said, you need to manage it like football manager managing his team. You need to know who are the defenders, who are the midfielders, and who are the strikers. And if there is a player or stock that is not performing, you need to make tough decisions to settle off and then buy a better company to actually make your team better. So I think this is pretty much the gist of it in terms of portfolio management. All right. So of course, if you have any questions, we will go to the Q&A session. But if that's it, I think thank you for going through to this month's Premium Club private session with us. And of course, we'll see you in our next week Not So Late Night show, as always, on our YouTube.
So I hope you really enjoyed the lesson and the video. Don't forget to click like, subscribe, and also turn on the notification bell button to get notified whenever a new video like this gets posted in the future. Of course, there are other Premium Club services that you might really want to check out, and check it out by subscribing to our Premium Club members, link in the description. See you in the next video. Bye bye.